Hello traders, welcome to your Follow the Bots daily S&P 500 trade strategy review.
Hello traders, Bill Duryea here with the trade strategy review. The S&P 500 managed to eke out yet another multi-year high, auctioning up in the overnight session to 1696. The market pulled back off the high prior to the open and traded back down at or near Monday's low at 1685, 1686. After pulling back to Monday's low, the S&P languished in a non-directional pattern, trading back up at or near Monday's settlement, pulled back again near the close and retested the low, but failed to retest the overnight high. Looking over the details of the intraday developments, the long opportunity prior to the rally up to the new multi-year high occurred at the close of, as stated before, the rally to the new multi-year high occurred during the overnight. The order flow monitor detected buy programs waning at the high. Following the flatline minor pullback, buy programs waning surfaced again when the market failed to retest the high prior to Tuesday's open. At Tuesday's open, there was a minor pullback at or near Monday's close, filling the modest gap. The market initially paused there. We had a sell programs waning alert, but there was no real uptick, and selling pressure came in immediately and drove the S&P back down to Monday's low. So the ideal short opportunity was missed because of its occurrence in the overnight session and because during the open the market failed to retest the high. The long opportunity developed today on the pullback where the S&P retested Monday's low. There was a pause above the low at 87.5, but then following that there was a minor downtick to 86. Sell programs waning occurred here at the low. There was never a second retest of the low. One tick down to 86, and then the market moved back up off of it. I initially bought the low at 87.50 and then scratched it following the downtick to 86 when price came back up to the location of the digital filter. And I attempted to buy the low again at 86.5, but price discovery failed to trade back to the low, and the market stalled here at 675. That meant getting long, one had to be willing to buy off the low, and there was an opportunity to get long again at 87.5. Following that, the market was basically flat. There was no clear direction for about an hour and a half. But eventually price traded back up at or near Monday's close to where the initiated selling occurred when price pulled back to fill the gap. There was an opportunity for the aggressive seller to short the retracement back at this minor inflection point, and that paid out a quick 1.25. At that point, I was still holding the balance of my long position, looking for the S&P to trade back up to 1692, but on the uptick here to 91.75, buy programs waning occurred, and that was the end of the up move. Late in the day, the market sold off and traded back down again to retest Monday's low. So there was a second opportunity to get long at the close. During the overnight session after Apple's earnings came out, the S&P rallied back up again to 91 and before trading back down to 1688, 1688.75. The purpose of placing the numerical references is so that you can see the potential opportunities and the trading decision points. And granted, the best opportunities occurred when most U.S. traders were not active in the market. However, regardless of whether you're awake and participating, you still need to note the outcomes, and doing so validates your read of the market-generated data. So had you been thinking to sell the high, whether you were present or not, you know selling the high was indeed the opportunity, and in the context of Tuesday's session, selling the high with the expectation of a pullback to Monday's low, that was the best trade one could have taken. What we're seeing here is extremely narrow range development. Earnings are coming in more or less in line with expectation, so there's no impetus to be an aggressive seller. However, the earnings are not providing the catalyst for the market to continue the up move, and momentum is more or less non-existent, volatility non-existent, and not to be redundant, but the rate of trade, volume of trade, number of trades, all of those things are at the minima statistical level. The market could sell off overnight just on the basis of lack of interest. When a market sells off because of lack of interest, you get this type of trickle lower, trickle lower, trickle lower, trickle lower type effect. And it puts you in the awkward position of having to sell the low. If you were able to trade today after hours and were able to get short at 1690, my suggestion would be move your stop to break even and let the trade play out. This minor support level that developed Monday and then was retested today is extremely weak. Price can easily breach support there, and the next support level is down at 1676, 1672. If the market was to pull back to those levels tomorrow or overnight, while we're still in earnings season, that would be an opportunity to get long. There's still enough hype in the market that the first good pullback is likely still to elicit a buy reaction. Alternatively, if the market continues to languish as it did Monday and today at the high, and then doesn't sell off until after earnings season, that's going to mean they sold the high, and looking to buy minor pullbacks will likely be disappointing. It's never easy to sell the breakdown. Breakdowns have to fall precipitously as opposed to chopping around, chopping around, chopping around, as we witnessed today at the low. This type of market development that occurs at multi-year highs is never fun. It's typically a long, drawn-out affair. The informed insiders are obviously selling at the high, but they're doing it at a pace that doesn't upset the apple cart and result in spooking the market away from the 1700 price level. There's a serious possibility that some negative news out of Asia or Europe will be the cause of the breakdown, and the risk is that we'll sleep through it. Once again, if the breakdown pullback comes sooner than later, there'll be good opportunities at these price levels. This is the least attractive type of market to trade when the range is narrow and when the price development has no real tradable range hour after hour. However, my counsel is not to despair, to contemplate the words of William Hamilton, trees don't grow in the sky, and markets don't go up forever. That concludes our trade strategy review for this Tuesday, July 23rd, 2013. I'll look forward to seeing you tomorrow morning at the Open.
Follow the Bots offers a completely new approach for traders. Follow the Bots provides you with tools that will allow you to trade with the bots and not against them. To learn more, take a tour of www.followthebots.com.